Good evening, ladies and gentlemen. How are you guys doing today? A warm welcome to one and all. This is Ashok Devanampriya. I am the CEO of Traders Gurukul and Straddle, an algo trading company. Friends, on behalf of Traders Gurukul, I'm extremely honored to welcome every one of you to INTRAZON 2.0, India's largest retail traders online conference. I feel privileged to see thousands of people joining us every day. From the past 3 sessions, the participation rate has been very good. Probably the theme is a crowd puller because the theme is exclusively intraday. Pure intraday models would be discussed over the period of 12 days. My sincere thanks to colleagues, management, and leadership of Money Control Pro for joining us as media partner and believing in our ability to deliver great conferences for traders and investors. Let me also take this opportunity to appreciate our title sponsor, Espresso, the Sher Khan Company, one of the leading discount brokers in India, for joining us on board. The speaker for today is my very good friend, Vishal Mehta, CMT. CMT is chapter chair for Mumbai. He is the chapter chair for Mumbai. He has experience with all kinds of technical and fundamental aspects and information. He worked in companies like Spider Software, Reliable Software, Financial Technologies, Thomson Reuters, and Bloomberg. He has been one of the successful traders whom I know personally. I feel it's a privilege and honor to have Vishal as my good friend. I am equally good critic also for Vishal. He has automated most of his trading systems and allocates some fund for investing through rule-based systems. His title for today is Smart Straddle Intraday Strategy. So my friend Vishal, on behalf of Traders Gurukul, Money Control Pro and Espresso families, I extend my warm welcome to you into this program as an elite speaker. Go ahead, my friend. It's your turn and the stage is yours.
Thank you, Ashok. Thank you very much. And I really want to thank Espresso and Money Control Pro and obviously Ashok and the team who has done a fantastic job of bringing this education, because I always believe the education is the first step for your growth. Because a lot of, to start a trading, the easiest thing is to just open up a Demat account and you can become a trader. But we all know that how hard it is to become a trader and make a living out of it is even more difficult. So that's where I really wanted to kind of congratulate you of making this awareness among the community. So let me start with my presentation. I will just share my screen. Just let me know if you are able to see my screen right now, Ashok. I'm going to go on a presenter mode.
Yes, perfect.
Awesome. So hey, good evening everyone. It's 8 o'clock and I really want to congratulate you as well for taking time out on educating yourself for one of the most difficult concepts in the trading that we always talk about is the intraday trading. So let's start. So the topic of the strategy today, I'm going to talk about smart straddle, or you can call it triangle or whatever as Shakespeare says, what's in the name. Okay, well, because I got a lot of points like, why do you call it straddle? Because the way the structure of the strategies, it can be triangle as well. It's not the point. It's about how smart you can look at from an intraday strategy perspective, and I'm going to talk about it. Just before that, just a disclaimer, I'm not a SEBI registered investment advisor or a financial advisor. Whatever the trades that I'm recommending is just for the presentation and educational purpose only and does not constitute buy and sell. Obviously, you should only raise the money that you can afford to lose. And thanks to SEBI, a lot of kind of risk and regulations that has come recently. A lot of deleveraging has happened in the market. And the most important point, although we are going to discuss about a strategy, my idea is not to give you a strategy. My idea is to give you a platform to build your own strategy. As we know that if you just copy paste anyone's strategy, will that work? Think in your mind. Answer is no, because what we have seen that if the strategy is not yours, or if you have not built the foundation, or if you have just started to copy paste it, the minute it goes into a drawdown, you have not lived that strategy, and there is a high probability that you will stop using that strategy. And that's why I just really wanted to open up your mind about just not doing standard straddles and strangles, but how you can get more innovative. And this innovation for us came through our own experience. We traded ourselves, made money, lost money, and when we lost money, we didn't stop there. We tried to figure out why did we lose money and what we could have done to at least minimize the loss. See, nobody can reduce the loss, or nobody can eliminate the loss. The trick is always try to reduce the losses and how it is going to come into your comfort zone. So with this, I think so Ashok has given a nice background about me, that I worked everywhere. So I run a blog called as Market Scanner. You can definitely go and check out, because where we put a lot of ideas, new in trading strategies and everything which can be of help to you to build the foundation of your strategies. I've been across Asia. I've been to, like, I never knew there was a central bank in Maldives, and I was called in Maldives to do training on technical analysis. So I'm very happy about it. I'm a co-chair for CMT, and I'm trading my young trader as well. Hopefully she'll become a good trader. I always get this question from my colleagues all the time: Vishal, you've been in the market for a longest period of time. What really helped you as a trader? And few of the books that I would definitely kind of highlight to you. If you can see a book named as Trade Like a Casino, that had a good impact on my mindset. The book that really turned me from a discretionary trader to a systematic trader by books by Larry Connors. And this was the book, How Markets Really Work. And in that book, the author talked about, edge. And I was alien to that word. What is an edge? Edge is nothing but your probability of win in the long run. And he was talking about 0.15, 0.18%. The highest he talked about, if I remember, was like 0.2%, 0.5%. And here I was looking at M2M screenshots of the biggest of the big traders. And this guy runs a hedge fund who talks about 0.5, 0.8 edge. And that surprised me. So I said, okay, what is that guy, this guy's trying to talk about? And that I started trading my journey. And by the way, this is my Amazon Kindle book. I actually read the ticks that you can see are the books that I've read. So whoever said that trading is easy is either lucky or is lying to you. It's not that easy. CMT, on the other hand, really helped me a lot to become a better trader, because it put the thought process, it put the right structure to learn about the concepts on technical analysis. And meeting the trader, I'm sure you would have met with lot of the traders. I got an opportunity to meet with this Mr. Gentleman, and that gentleman is the founder of MACD, Gerald Apple. Okay, he founded the MACD. And when you go and meet him in New York, he talks about how the market functions, how he sees the market. If you're a technical analyst, you would have definitely read a book by Martin Pring. Nobody can, I would be exaggerating a situation that you cannot be a technical analyst or call yourself technical analyst unless and until you read about Martin Pring. I got an opportunity to interact with him as well. JC Parrott, brilliant guy, no nonsense technical analysis, simple support and resistance, and he's bang on. And this gentleman that I'm standing along with him, the same height as me, was Tony Saliba. He was the only option trader featured in Market Wizard book. This was the Market Wizard book that really helped me. Whenever I'm in a drawdown, I just pick up a Market Wizard book and start reading through the chapters. Tony Saliba, there is a chapter called as One Lot Trader, and he actually traded one lot, only one lot, throughout the 1 year till he became comfortable with the system. And sometimes for us, we looked at a strategy on a webinar or anything, and from the next day we start with 10 lots, 20 lots, 30 lots, and once we have a small loss, we just abandon the strategy or maybe blame the trainer or anything of that sort, but never blame ourselves, because yeah, it was a strategy, it was working in the back test, why it should work in the future as well. But that's not how things work. Tony Saliba traded the option for 1 year, only one lot, till he got comfortable. So that's how it is. So yeah, Ashok.
Yes, sir. So, friends, the title sponsor for Intrazon 2.0 is Espresso, a Sher Khan company, one of the well-known discount brokers in India who don't charge for your losses and only charge when you make a profit. More details in the subsequent sessions. Thank you.
Very interesting. So it's good to know that brokers are looking after us when we are actually making a loss. So that's good. Thanks, Espresso team.
That's quite good, no?
Yes, yes, yes. And
Yeah.
most of the time as a trader, we are right only 50 to 60% of the time. So most of the time we are paying brokerage when we are losing. So it definitely adds up to our kitty of a PNL. So that's good. Thanks, Espresso team.
So there's only
So
one point to make here. See, the
yeah,
problem is most people think this broker is like a hafta vasuli person. Okay, that broker is eating lot of money. But fact of the matter is the brokerage is the most smallest component of our cost. People don't even consider STT slippage, which is lot more money. When we expose them to reality, they'll be wondering, oh really? I never knew. I always did brokerage is high. Brokerage is never a big cost for us.
and also remember, if a broker is giving you a platform, there is a cost associated with it. So I always
Yeah.
believe that if you're not paying for your brokerages, then you are the product. So yeah, if they are charging, it's good, but it has to be reasonable. So yeah, thanks. So now coming to how do I go about building a strategy, and I have talked about in all my numerous presentation. For many of you would be the repetition, but many of you it will be something new. So I will take that liberty of going through this presentation again, because I'm a trader. I don't make strategies every day for teaching. I trade some of the strategies that I trade. So I don't have every new strategies every week or every month. But always remember this: when you go about building a trading strategy, you should have a fundamental philosophy of why that should work, and that should be an extension. I still remember speaking to Atul Suri, who used to work with Rare Enterprise, Mr. Rakesh Junjunwala, and we had this candid conversation where he said, and which was beautifully ingrained in my mind, that a trading strategy should be an extension of your nature. I'm going to repeat it, and that's his word, not mine. Okay, a trading strategy should be an extension of your nature or your style. What do I mean by that? I'm a kind of a guy who always believe, when I read a lot of books, and one book really dented on, like, in a positive way, was Rich Dad Poor Dad. And we as an individual or a middle class family were taught that never spend too much. Okay, always हिंदी में बोलते हैं कि अपनी चादर जितनी उतना ही पैर फैलाओ. To quote it in English, just spend as much as you can earn. But what Rich Dad Poor Dad book told about, never think about that way. Think about it, if how can I afford it? We use this word, I cannot afford it. And I always got really inspired that how can I afford it? It's the word, just a change. I cannot afford to how can I afford? And that's where my fundamental philosophy was. So even if I go to buy a camera, and I was just speaking to Rajiv, one of my good friend, and we bought a Logitech Brio. Usually people tend to scroll the Amazon from lowest price to the highest price. I tend to do it differently. I actually put the ascending order or descending order from the price. That means the highest price camera should come up. And I actually bought the highest priced Logitech Brio. And that was my style, because I always want to think that how can I afford the costliest thing and work backwards. And same thing translated into my market observation, and where Ashok said, I will buy the stocks which are making an all-time high. Okay, a lot of people, fundamental analysts or technical analysts, may get worried that why would you buy a stock at an all-time high. And in my belief system, I'm again repeating, in my belief system, and my dad once told me that Infosys was trading at 12 rupees and it went to 12,000 rupees. It cannot go from 12 rupees to 12,000 rupees by making an 52-week low. It has to make a 52-week high or an all-time high. The thing that can come your mind, ke all-time high, if I would have bought it, and what if I got stuck? And that's where this third part of the risk management comes in. Build rules with risk management. So you had a rule that I'm going to buy something at an all-time high, but does not mean that I'm going to just sit like a sitting duck to be shot down. I'm going to have rules. I'm going to have a rules to entry. I will have a rules to exit, and I will have rules to trail my stop losses and the risk management. Once I have those rules, I'm going to backtest those rules. And once that backtesting shows me some positive result, I'm going to talk about strategy optimization. Now, a lot of traders think that strategy optimization is bad. It's curve fitting. And a lot of people don't understand the difference between the two words. Curve fitting and optimization. Curve fitting, let me just give you an example. If I'm going to take a two moving average crossovers, okay, say 520, and it is a profitable strategy, okay, but what if I'm going to do 421? That should, the PNL should be just near about 5 and 20. It should not have a material difference. But what if I do 3 and say 18? All of a sudden my PNL become like the dream come true PNL. And I said, no, 520 doesn't work. 3 and 18 is the best strategy. And I will only trade with that strategy. That's curve fitting. What is strategy optimization is to manage your drawdowns. Say, assuming you're keeping your stop losses much nearer, and that's why your stop losses are getting hit too many times. You may want to widen a stop loss a little more, maybe not 30%, maybe 40%, but it should not have a material dip on your PNL, and that you are comfortable with the drawdowns and the returns, and that's strategy optimization. And then once you have optimized your strategy, you would want to forward test it, because a lot of assumptions that we have about the market fails when they are traded with the live money. And we had a similar example with one of our option buying strategies. Okay. And then once that is done, you trade in the live market. That's the most important thing. And that's why a lot of us directly learn the rules. Okay. Rules, not even risk management from any of the webinars, and directly trade in the live markets. And when we don't make money, and then we wonder why people make money and I'm not able to make money, because those people who made money have gone through this complete cycle of having a fundamental philosophy to market observation, to build the risk management with the back testing, because they get the confidence from the back testing, forward tested, and then traded it live in a small quantity. And once they are comfortable, like one lot trader of Tony Saliba, once they get comfortable, then they increase the position size. I may sound little harsh, but don't get me wrong, guys, but I've seen personally many people blowing up the capital of the same strategy that we are actually making money. So somewhere something would have gone wrong. And most of the time, the wrong part is the position sizing. And the greed is takes better of them. Okay. So just try to avoid that. So my fundamental philosophy. Ashok, do you swim?
Yes, sir, I do.
Awesome. So if you're swimming with the water current, and opposite to you there is Michael Phelps, okay, but with a strong water current against him. I'm talking about very strong current against him. Okay. What is the probability of you reaching the shore much faster than Michael Phelps? Okay, Michael Phelps maybe reach the shore, but you will reach faster, or he? And if the water current is you will, right?
I will win the game.
Obviously, because the water current is behind you, and even if you are an average swimmer, which you are not, I know, but even if we are an average swimmer, because of the pure water current behind us, in the aviation industry it is called as tailwind. Okay, and what the other guy who is trading against the water current is called as a headwind. The wind is coming from opposite direction, so you will always find it difficult to swim when the water current against you. So that's my fundamental philosophy. I'm an average trader. I want to win, or I want to trade when the water current is behind me, not against me. And accepting that and I'm an average trader itself is a good win for me. Okay, because there are good traders and I really appreciate them. But I cannot handle the large drawdowns. That's not my style. That's not my fundamental philosophy. I can be happy with 30 to 40% return, but I cannot be happy with a 20 to like 30 to 40% drawdown. So I try to control my risk. Rich Dad Poor Dad once again. The fundamental philosophy. When you read a book which you like, and I like a book called as You Can Win by Shiv Khera. The book was written as best-selling book on motivation. And I was like surprised. And that's what Rich Dad Poor Dad also says. That when there is a book, if it is written so beautifully, why do we not get something like best written book? Okay. Even if the author is amazing, why do we call them? They are artists. They are putting so much of an effort, but we are still say that it's a best-selling author. Everybody is interested in selling. Okay, everybody's interested in selling. Okay, now the biggest guy. Okay, the biggest guy, Reliance, also is selling. Everybody is selling, so no harm in selling what we have. Now, let's talk about the market observation. If you are an option, your view about the market is bearish. Your view about the market is bearish. So there is an option buyer who would buy the option, and there is an option seller who would sell the call option. Both of their view is bearish, and I have taken this image from my good colleague Kiruba Karan from Square Off. Unfortunately, the credit went away. I'll put it up, but I've already spoken about credit to the right people, right? So, as an option buyer, if I'm a bearish and the market starts going up, I will lose money. Yes. If I am an option buyer and the market actually starts going down, I'm going to make money. Okay. And if I'm an option buyer, if the market remains sideways, I'm going to lose money. Guys, any idea why would we lose money even if the market remains sideways? Whereas as an option seller, I'm going to make money. So let's see, make it little more interactive. If I can see some chat or put out some messages that says, why would an option seller will make money when the market is sideways and option buyer will lose money? Ashok, let me know if you get some answers.
Sridharan says theta.
Very nice. Theta. And I think so you got it right. A lot of people in the industry make fun on Twitter that theta is not an edge. Good for them. But for me, theta is an edge. I've been wrong many times, but still end up making money. Okay. And theta, for me, it is an edge. Maybe not for them. So let's respect their view and respect my view. So that's what is very important. As an option seller, the market observation is even if I am wrong, I can still end up making money due to theta. And that's what I meant by water current behind you. The theta is your water current. Every day it is pushing you one positive territory. Even if the market does not do anything, it is going to make money for you. So I'm sure when you are going to see this, a lot of people will talk about, Vishal, why everybody is promoting option selling. And trust me, I'm not trying to promote option selling. It is a good source of income, but not the quick rich guide to option or making wealth. Okay. If you remember, everybody got freaked out on 16,450 CE when it traded from 100 rupees to 800 rupees in matter of seconds and went down. And I always believe, and this is my belief system again, that we as an option seller are like in Hindi movie. I was just talking to Ashok about Hindi movies, right? In Hindi movies, there is a famous way of, playing game with villains. What they do is in the revolver, there are 5 bullets. You remove 4 of them, keep one, rotate the revolver and put it in. So you don't know in which fill the bullet is. And you give the gun to the villain and say, you know what, I'm or maybe put it on his head and say, I'll go first, and he clicks and the bullet is not there. Then he gives the gun to the other guy. So that's what if you're going to do a naked option selling. Okay. So there is going to be one day, and trust me, this is a fact of the life. And even I believe and I know that there is a one bullet that is waiting for me and I'm prepared for it. And that's where the risk management comes into the picture. There is one bullet waiting for me to be shot if I'm an naked option seller. Either you live with that or you don't live with that. Choice is yours. So market moves in trends. Being a CMT, I have learned only this thing. Market moves in trends. Either market moves in an uptrend, either market moves in a downtrend, or remains it sideways. So as an option seller, what should be my strategy for the market trends? If the market is an uptrend, obviously I can buy call option, but hey, what? My fundamental philosophy is to sell when the water current is behind me. I need to be a seller. And if the market is going up, what I can do is sell put option. What if the market is going down? I'm going to sell call option. And if the market remains sideways, I'm going to sell call and the put option. So let me ask a question. How many of you know, Ashok, obviously you are not allowed to answer this question. How many of you know the man who solved the market, who is running a multi-billion-dollar hedge fund and making, lack of a better word, shit lot of money? And he's
That
the
book,
prime example where systematic trader do also make $1 billion, because every time we talk about trading, we always get this gyan about who is the richest man in the world is Warren Buffett. Okay, so that means fundamental works. I'm not against that, but there are also a lot of examples where not in front of us, but there are people who have actually made billions of dollars doing systematic trading. Any guys who can answer that one?
yeah, Kabir Nayak gave the answer. He mentioned Jim Simons. By the way, that book is on my table only right now.
Wow. I hope you are going to solve the Indian markets soon, huh?
Even if we solve 1% of what he has done, we will be heroes.
True. So right, the answer is Jim Simons. But there is another very interesting fellow that I follow very closely and is a very good friend of me. The man who showed me how to trade the 920 straddles, and for me, he was an inventor of that 920 because I never knew about 920. Okay. Any names that anybody can think of? Okay. So his name is Nitesh Narang. He's the founder of a backtesting engine, which is called a stock mark, and that really helped me to think systematic way of option trading. I don't have to, because I was always a systematic trader. When I moved my journey from a discretionary trader to a systematic trading, it was very difficult because I see a lot of people making big M2M screenshots. But whenever I approach them, what I've realized, they were all discretionary traders, and no offense to them, they are great discretionary trader, but that's not me. So I wanted a way to decide that how do I trade systematically, and the best and the easiest way got through a trolling was 920 straddles. And I don't have to be a rocket science because a lot of you know what is a straddle or a triangle. You just take the at the money call put and sell them. That's straddle. Or maybe if you want to make a delta neutral, take a fixed premium and sell them. So why straddles or a triangle? The answer is market trends only 30% of the time, and 70% of the time it remains range bound. That's the market characteristics. Remember our 80-20 principle, which we called as a Pareto. Like 20%, no, 80% of your gain will come from 20% of your customer. And that's what also gets reflected in the market. If you would have seen that Nifty moved from 10,000 to say 16,000, in that period, only 20% of the time, most of the kind of price movement has been covered, or 20 to 30% of the time. Remaining 70% of the time, it remains sideways. So when the market is in sideways market, theta decay on both the legs gives us a lot of money. There are ways people trade these straddles of 920 or a 930 depending on your style of trading. Usually trader stops out the entire straddle if the stop loss is hit. on the combined premium stop loss, or you can put it on the individual legs as well. So let's take an example of best days for delta neutral strategies. This is a bank Nifty chart, and what you can see where my underlying, the horizontal line is from year to year was was a complete day. I've taken an intraday chart from March 26, and look at this chart of Bank Nifty. Bank Nifty virtually did not do anything. It just moved between 33,700 to 33,400, a broad range of 300 points. Just imagine if you were a 920 or a 930 straddle, okay, what would have happened? At 920, I just came and sold at the money call option, and I put a 25% premium stop loss. So I sold at somewhere around whatever the price is, somewhere around 110 or somewhere around that at the closing of 5 minutes at 925. Put a stop loss of 137 rupees, which is a 25% of the premium that I've sold. And the market did not do anything. My stop loss did not get triggered. The thing that I sold at 110 closed at 40 bucks, which gave me a good money. What should have happened to the put option? Same thing. The market at 925, I come and sell a put option. And the minute I sell a put option, I'm going to look at what is the closing price or the price at which I have sold the put option. Just put a 25% stop loss on the top of it. And then you wait for your stop losses to trigger or wait for the end of the day. Remember, guys, this is not the strategy. I'm just trying to give you and open up your view about a lot of things. This is not the strategy. So once we have sold a call and a put option, we have put our stop loss and just waited. And this is a systematic way of trading for me. No adjustment required. Either my stop loss will get hit or I'm going to close at the end of the day. So as we have seen the chart, the market was not doing anything. The call that we have sold at 100 became 40 rupees. And the put that we have sold at 100 rupees also became like 20 rupees. So I pocketed a nice bit of premium for myself. And that's what we always say, the market remains in the range bound. Even if the market did not do anything, I still end up making money. And the secret to making this money was you guys only told me the theta decay or the water current behind me. But there is a problem now. And this is what I want you to start thinking. I always ask my students, what is the best way to understand whether the market is in an uptrend or a downtrend? Okay, can anybody put it out on the chat that what is the best way to figure out whether the market is an uptrend or a downtrend? Let's see if you have any innovative answers on that.
My simple answer would be if market makes higher highs and higher lows, it's uptrend. If it makes lower lows and lower highs, it's a downtrend. That's the simplest way I can define.
I'll be a devil's advocate here, Ashok. For you,
go ahead.
The lower top and lower bottom on a lower time frame may be an opportunity for the people to buy at the higher top, higher bottoms, right?
Okay.
So it is going to be subjective, but yeah, there is
Right.
a way of doing it, what you just rightly mentioned. What about others? What do you think is the best way to figure out whether the market is an uptrend or a downtrend?
Sridharan says use EMA to check cross check. Maybe price above the EMA it's uptrend, below is downtrend. That's one way.
Fair point. Fair point.
Second point, I need to check the other stories. Folks, any other responses, please?
Because I'm not going to speak for 2 hours, guys. Come on, it has to be interactive.
On a daily chart, below or above 50 SMA. That's what Wazi says.
Awesome. Now
and
I'll give the
Raghavendra
answer.
says maybe open interest build up.
Perfect. The easiest answer for me to find out whether the market is an uptrend or a downtrend is my own personal P&L account. Okay. If the
Wow,
market
good
is
one.
going up, my short position will lose me money. And the minute my short position start losing me money, I know the market is an uptrend in my time frame or in my risk appetite. Okay. And if I'm long and my long positions are losing money in my time frame on my risk appetite, the market is in downtrend. My personal P&L, and that's what also taught us that why we should look at this thing. Okay, I'll tell you why. Now just understand, and this is a byproduct of our own P&L. This strategy is a byproduct of our own P&L, my own P&L. Okay, so we have learned that when the market is sideways, the call and the put both made money, which is good, right? What else you want in the life? Call mein bhi paisa ban raha hai. We are making money on the call side. We are making money on the put side. But the problem starts. Market also trends about 30% of the time. Now what happens is, look at the Bank Nifty. On July 15th, the Bank Nifty trended completely upwards, right? It was a clear higher top, higher bottom formation as what Ashok just mentioned. What happened to when the market goes up, the put option actually deteriorates, right? If my option analysis is good and I've understood what is selling of a call and a put option, I do understand if the market goes up, the put option will go down. And that's what happened. If I would have sold, say, whatever 35,800 put at around, at around 170, it almost closed at 5 paisa. So that's good, right? Market trend up. I sold the put at 920. At the end of the 920, 925, I've sold it, put the stop loss, and it closed at 0. But then there is a problem. The other leg. Because the market was trending up, I sold the call option. And interestingly, my stop loss got triggered. If I would have put a 25% stop loss. And as we say, when the new trader comes in, they don't put a stop loss. 110 or 120 sold call option will go to 300 rupees. Then only we'll realize, oh shit, I should have put the stop loss. But assuming you were a systematic trader, you sold at 100 and at 125 or 130 odd levels, you exited your position. So you incurred a loss when the market was going up. I'm going to repeat one more time because this is very crucial for our strategy. The market is trending up. So obviously at 925 would have sold something. My put option would have gone 0, or if it is expiry, then it would have gone 0. Or if it is not an expiry, still I would end up making money on the direction or on the delta fall. But my call option will get stopped out. So that's a problem for me, right? What about, let's take another example of Bank Nifty in a downtrend, because I said 30% of the time market trends, maybe it a downtrend or an uptrend. And as I can see over here, there was a clear trend day like today, although there was some recovery at the end, but it was a clear trend day on the downside. So what do you think would have made money for us? Selling of a call option or a put option? Let's wait for a few answers. On this downtrend day, what would have made money for me? Selling of a call option or selling of a put option? Ashok, we have any answers?
Selling a call option by Raghu, Amit, and Kailash.
Awesome. You guys have learned the art of selling options, right? Yes. Selling of a call option would have made money. So let's take an example whether we actually made money or not. So yes, say if you would have sold and call option at the money or with a sudden strikes, sold at 160 became 0. But when the market is going down, which leg is going to give us a problem? Because our first leg made money, the call option, Amit, Raghu, everybody said that call option will make money. But when the market is trending down, one leg is going to give us a big problem. and that leg is put sold. And what happened to that put sold option? If I would have sold on a 920, immediately after 25% stop loss got triggered. And if you're a disciplined trader, and I keep on telling on all my stuff, markets are nothing but a systematic transfer of money from an undisciplined trader to a disciplined trader. The credit goes to Mr. Warren Buffett when he said that the market is nothing but a transfer of wealth from an impatient investor to a patient investor. But in trading, there is no patience. It's all about discipline, right? And that's why I've just molded it to comfort my mindset. The market is nothing but a systematic transfer of money from an indisciplined trader to a disciplined trader. And luckily, I was a disciplined trader. I got my stop loss hit, but I still lost money. So I made money on my call side, but I lost money because my stop loss would have got triggered. Can I? And this was my thought process. As we say, the necessity is mother of invention. That's what we all do, right? We don't want to lose money, but I told you that we can try to minimize the loss. We cannot eliminate the loss. But what is the way of minimizing the loss? And that's where this strategy came into the picture, smart straddle intraday strategy. So again, guys, I am repeating one more time that I'm trying to give you a strategy, but just don't blindly go by the strategy. Just understand the core principle of the strategy. And trust me, you can build much better, much powerful, much robust strategies based on just on this observation. So I'm going to take an instrument Bank Nifty option. Hey, you know what? We are a trader. We want to make money every day. So let's trade them every day. I'm going to take a weekly expiry because Bank Nifty weekly expiry is pretty strong, which is liquid. I can get in and get out. Definitely the 500 strikes are much more liquid than the non-500 strikes. But yeah, you can take that. Rather than a 920, because now 920 has become so much famous. Some credit goes to me and Nitesh for promoting that big time and getting told on it, but yeah, whatever that. And there was a very interesting thing. Maybe I'll talk about the turtle soup at a later stage if somebody has any, want to answer that. Because a lot of people started using 920 straddle. The reversal started happening. So you can wait for 930. We have tested with 920 also. It works beautifully. We select the stocks or we select the option premium just trading above 100 rupees. Why 100 rupees? Why not ATM? Why not 500? Why not 300? I will answer that at the last slide. So I've already answered them before you have a question. But just for the timing, be with me and understand that I'm going to sell a call or a put option and a put option which is just trading above 100 rupees. Not short them right now. Now the twist comes in. Now the real what we call as a put the knife and twist the knife. Now I'm going to twist the strategy. Up till now, you have studied that come at 930 or a 920 and sell at the money call and the put option. That's the 920 straddle strategy, right? Here what I'm going to do is I'm going to put the knife and twist it. I'm going to take this call and the put option not at the money, but I'm going to put say options which are above 100. Okay, so usually they will be bit out of the money, so that's why people call me that it should be called a triangle, not a straddle. But on a Thursday it will become a straddle. So name doesn't, just don't go in the name, but just understand the psychology and the reason why we have built that strategy. So we take this call and the put, and they are just trading about the 100 rupees. We actually don't sell them. We don't sell them. At 930, we figure out, okay, this is the call, which is just trading above 100 rupees. And this is the put, which is just trading above 100 rupees. Because if you're going to go at the ATM, it will be the highest premium. And the more you just try to go above it. So somewhere the differentiator will come that an option, call option will be trading at 100 rupees and the next option would be trading at 90 rupees. Now that option that will be getting selected. And where we are not going to sell them, we are going to put a 10% stop loss below the current market price. So we figure out whatever the closing, and we have taken enough example. So just understand this. We have taken an enough example to explain you the process. You put a 10% stop loss below the current price, not sell at the market right now. Just wait. Keep your gunpowder dry. So let's take an example that you go at 9:30, figure out that one call option, not at the money, maybe trading, if it is not a Thursday, slightly out of the money. Okay, it's trading at say 103. We will not sell at 103. We will put a stop loss order for entry at 92.7, which is just 10% below 103. Okay, and we keep that order in the system till 3 o'clock. Okay, whenever we say EOD, you can put it at till 3 o'clock. And similarly, I'm going to look at the same time at 9:30, I'm going to look at PE trading at 105. So we will not sell at 105. We're going to put a stop loss at 94.5, which is 10% below 105, and keep it till 3 o'clock. Now, these orders may get triggered and may not get triggered, and we'll see with both the examples. Okay. Once those orders are triggered, immediately we are going to put a 30% stop loss on the entry price as and when the order is triggered. And now your question would also come, why not 30%, why not 40%, why not 25%, why not 21%? As I told you, there is a strategy optimization, not a curve fitting. If you take 25 or 30 or 35, you still end up making money, but somewhere we have to decide which one to take. And we have taken 30%. If you are not comfortable with the risk, you can take 35, or if you are not comfortable with the very high risk, you can take 25, but don't go below 10. Otherwise there is no point, it will immediately get triggered. So have some logical answering to your strategy as well. So what will happen is at 9:30, I'm going to look at which is the option trading above 100 rupees, which was at 103. I'm not going to sell at 103. In brokers account, and Espresso has this facility where you can put the option to sell not at current price, but if it goes below say 92, only then only sell. Otherwise I'm not interested in selling. So you can put that order into the system. It will not get triggered because the current market price is 103 and you are trying to sell at a lower level, not at the higher level. Remember that. Once it gets triggered at 92.7, then we are going to put a stop loss because the strategy is now there. And I'm not going to trade naked. Even if I'm going to trade a naked, I need to have a stop loss in the system. I'm going to put a 30% stop loss just or at my entry price, that 92.7. I'm going to put a 30% stop loss, which is at 120.5. And similarly, when the PE get triggers at 105, then we put a stop loss at 136.5, 30% above the entry price. Okay, my bad. Sorry, my bad. PE triggered at not 105. It should have triggered at 94.5, and the calculation 30% from 94.5. So don't confuse with 105. I apologize. It should be 94.5. And I'm sure a lot of you will have got confusion. Let's run with the example. And then if you don't understand, I'm open to take your questions. Okay. So when do we exit the strategy? We close at 3:20 p.m. or the stop loss, whichever is triggered earlier. So remember our example of Bank Nifty when the trend was clear cut. I'm going to go back. Sorry about this, all this thing, because I just want to make sure that you understand this concept really well. Clear cut uptrend. What made money? What should have made money? Put option. So when we sold the put option, 35,800, it became zero, made money. But what lost the money? The call option. Remember? The call option we sold and it got triggered and I had lost money. What if I could save this much amount of money when the market becomes trending? Now we're going to go back to the same examples. The market is trending. At 9:30, market made a dip and then started recovering one way up. It started just going up. At that juncture, at 9:30, I go back to my espresso and I put my option chain and I look at the option that is trading just above 100 rupees. and I can see the option that at that point of time was trading as 25,100 PE. Market went up. In our first example, we made money because the market is going up. The sell put option will make money. At 9:30, I figured out what is the option that is trading just above 100. So maybe due to the volatility, or it was a Thursday. Okay, it was a Thursday. The difference between the strike price would be larger. So maybe the previous option was trading at 90 rupees and the next option, immediate option, was 149. So I looked at this option at 25,100 PE at 9:30, calculated or fixed its price at 9:30, which was 149.6. Do I sell here? The answer is no. As per the rule, I'm going to put a stop loss 10% below of the 9:30 price. So 9:30 price was 149.6. I deduct 10% from 149.6. That actually gives me a price of 134.6. And I'm going to put up order in espresso. Just sell this option when it is 10% below 149, which is 134.6. Till that point of time, don't trade this option. And as the market starts moving up, your option, which was trading at 149, started to go down, and you get triggered in. You got triggered in at 134. So you lost about 10%. If you are trading at 9:30, you would have sold at 149, and you would have, in this scenario, you are not selling at 149, but you are selling at 134.6. So you are letting some of your profit go. But where does it help? And okay, so once you enter the short, you immediately put a 30% stop loss above your entry price, and which is 175. So I sold at 134.6, put 30%, around 175 is my stop loss, which never got triggered. Sorry. 149 became 0. Now the twist in the strategy comes handy. Remember, my losses teaches me, and my loss taught me that whenever the market is trending, I don't want to go short. At 9:30, what I looked at is the call option, which was just trading above 100 rupees. Okay, my bad. It was trading at 103.9. Okay, I did not sell at 103.9. I actually put 10% below. I put 10% below, which is 93.3. That stop loss was lying somewhere around way below here, but that never got triggered. That market, because of 9:30, market just kept on going up and up and up and up. That 93.3 CE option never got triggered, and I never had a loss in that. Remember, if I would have traded 9:30 straddle at the market price of 103, my stop loss at 25% would have got triggered somewhere around here, and I would have made a loss. But just become little smarter, not very big smart. Okay, no IQ. Just getting little smarter. I just never put at the market price. I said, okay, if the market has to trend, let it trend before it, my stop losses get triggered, right? So I gave him a wiggle of 10%, trying to forgo some profit. But in that process, I actually end up saving 15%, because if I would have shorted at 9:30 at 103.9, I would have got stopped out and I would have lost 25% of my profit. And that would have created a dent on my profitability. Let's take an example of Bank Nifty downtrend, because I remember you guys told me in a downtrend who made money. So I'm going to repeat that problem. And your everything starts with a problem statement. This was a downtrend where in Nifty you told me, I think so it was Bharat, few names I forgot the name, but you told me that C would have made money, but PE leg would have created a lot of problem for us. Yes, that's so true, right? PE got problem and C made money, but we lost money if you were just trading at 9:30 at the market price. But in this example, in a downtrend in Bank Nifty, you can see over here there was a clear-cut downtrend. From 9:30, it just kept on going down, 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 and down. What would have made money? No brainer. I would have come at 9:30. I figured out that the option that was trading above 100 was 111.4. I did not sell the option at 111.4 because I know I'm not a great discretionary trader. I want the market to tell me that the market is going down. Market is going down. So this is a call option. Sorry, my bad. Not a put option. So I want the market to tell me that it is going down. If the market goes down, automatically my CE will also go down. And what I did was at 111, I calculated 10%, put a stop loss in espresso just below 10% of 111.4, which is at 100.3. In the next bar itself, it got triggered. The minute it got triggered, the first thing that I will do as a trader, from 100.3, calculate 30% above the entry price, which is my entry price is not 111.4, guys, remember. 111.4 is just the reference price from which we calculate 10% below and put the stop loss in espresso to go short, which got triggered in the previous next trade. And then I put a stop loss 30% above the entry price, which is 130. And the stop loss never got triggered, and whatever I sold at 100 rupees became zero. Now you told, and I remember that when the market went down, the put side had a stop loss triggered. Let's see how I was able to safeguard myself from that situation. I've taken a put which was just trading above 100 rupees at 9:30, which was trading at 101.4, 10% below 112.70. Because sorry, my option was trading at 112.70. I put a 10% below, which was 101. This candle missed by only 2 rupees. It was 103 or something, and it was at 101.4. So it never got triggered. So I never had a short put position. If I would have shorted the put position here, my 25% stop loss would have got anyways here. But during the entire day, during the entire move, my stop loss was sitting in espresso at 101.4 and never got triggered. Never got triggered. And the prices just went up and up and up. And in that way, I was able to save my money on that straddle. So, have you backtested that strategy? Before anything, we do backtesting, and that's what our philosophy is, like a casino. If you go to casino knows the edge is on their favor. If the player plays long enough in the casino, he will always lose money. And that comes from a confidence of probabilities and having an positive expectancy strategies. And that's what we as a trader do. So Bank Nifty started from 2016 or 17, yeah. The weekly option started from there. We calculated from there onwards. In total, we made about 15,964 points. And guys, this is after deducting 2% of brokerages and slippages and everything. Okay, it's not just numbers, not pure numbers, because most of the time, and I was speaking to Ashok as well, that all of the strategy that we take out at least 2 to 3% of the brokerage slippages in the real world. And backtesting has to be conservative, because in backtesting you are assuming that you will get slippages in every trade. But in reality, there will be days where you will also get a positive slippage. If you are trying to sell something at 101, the minute your order hits the market, it may become 103. And it's not negative slippage, because you are planning to sell at 101. But you got a fill at 103. That's a positive slippage of almost 2%. But in backtesting, let's be conservative. So there is a high probability that we will make money in the future. So overall, we made 15,964 points. That's roughly around 16,000 points. Max profit we made 390, and the max loss points per trade was 135. And usually a question would come to your mind. If I would be in your position, I will say this is a what do you say, scam strategy, because you said that you are going to sell an option which is just above 100 rupees. How can you make a profit of 390 rupees? And the answer to that is March crash. In the March crash, when the circuit hit the market, the immediate option available was above 100 rupees was 390 rupees. Okay. What is our percentage win days and loss days? So about 62% of the time we are going to win, 38% of the time we are going to lose. Our average win to average loss is perfect. We are going to have a consecutive winners. That time you will feel like a god because you had 18 trades or 18 consecutive winning days where you just made money. You don't have to do anything, just come here and you will think to yourself, boss, finally I have found a holy grail. Finally I have found out money printing strategy. It doesn't work because the immediately you double your capital, this maximum consecutive losers will hit you. So it had a 10 consecutive losing days as well. So nothing is free. Okay. Only mother's love is unconditional and free. Beside this, everything costs. And average yearly profit in points is 3,000. Maximum drawdown that we have seen is 432 points. So as a system trader, we always calculate this Kalmar or overall profit divided by the maximum drawdown. If the Kalmar is greater than 1, which is positive expectancy, or it will sustain over a long period of time. If you have a greater than 2, very good. If you have a 7, your equity curve will be always be an uptrending equity curve. What I mean by equity curve, this is the number of points that we have made across the years. So we have finally found the holy grail. Why should we not make money every time? And that's where I give credit to my good friend Madan Kumar. He just opened up my vision about following a strategy when we are in drawdown. And I'm sure every one of you go through a drawdown. If a person says I'm not going through a drawdown, he's lying. Or maybe Jim Simons, okay, either of the two. I think even Jim Simons had gone through a drawdown and they had quite a bit of withdrawal from their funds. But everyone will go through a drawdown. And that's where Madan, this slide, and all credit to Madan, I always give him that credit to open up my vision about laws of large number. So what we did was we plotted the weekly points that we would make if we would have followed the strategy from 2016. Most of the people will stop trading the system when you have 1, 2, 3, 4, 5, 6, 7, 8, almost 8 consecutive. I will not call it consecutive because there were 1 or 2 weeks which are profitable. But if I would have got 6, 7 weeks consecutive losses, because I have not backtested that strategy myself, because I have not traded that strategy myself, because that strategy is not an extension of my natural fundamental philosophy about the market, because I've just learned it and thought I'm going to become rich, most of the people will skip the strategy. We will jump to next guru, next strategy, next in intraday zone. Okay, and a lot of people will skip it, and that's where markets are nothing but a systematic transfer of money from an indisciplined trader to a disciplined trader. If you had a 3 consecutive weeks loss, after that even you had 2 profitable week and you again have a 3 consecutive, there is high probability that you will lose. And this is weekly numbers. Interestingly, if I change my microscope of evaluating myself or my strategy from a weekly instant gratification period to a little higher, to a monthly period, I can see the months that were looking so horrible to me, the sea of red, only lost about 114 points. The week that looked miserable, about 3 consecutive months, weeks losses, had only minus 2 points because there was a profit over here as well, which is hidden by this square. We only lost 2 points. But a lot of traders will also skip the strategy if they have 1 month of loss or maybe a 2 month of big loss. And they say, you know what, interestingly, this is not even a big loss. But they think that if I am trading that strategy, it has to give me money every day, every hour, every week, or every month. The answer is no. Market dynamics will keep on changing. the most interesting aspect that changed my perspective about trading is that strategy never had a losing quarter, and it never had a losing year as well. In fact, in 2019 crash or 2000, like, it made a good amount of money. Even in 2020 when the market crashed, it kind of gave us a lot of money. So that's the problem with a lot of us, including me, when I started out. It took me a while to understand the laws of large number. So I always tell Madan that you have really helped me. So I will carry that baton to, kind of whenever I am going to put out there, that laws of large number will be presented. Now, the question that should come to your mind, Vishal, I think you have given us a wrong strategy, because you have taken a specific number like 100 rupees above only you have to sell. You have to put 30% stop loss. You have to sell at 9:30 only. If I would have not put some rules, how would I backtest it? So there has to be some kind of rules given to it. But what we did was we just calculated the premium part of it. If you would look at it, this is the backtest that we did. 100 rupee premium, I would have made 15,964 points with a max drawdown of 432 points. What, Vishal, if I'm a conservative trader, I don't want to make a lot of money, but I also don't want to lose a lot of money. Then rather than 100 selling option, you choose the options which are trading just above 50 rupees. You will still end up making 11,000 points with just a drawdown of 300 points. 75, you would make 14,000 points and just have a drawdown of 251 points. Can you see across the premium at 125 also? I'm going to get more premium, but my drawdown also will increase. At 150 premium, I will make the biggest amount of money, but my drawdown will also be biggest. So that's a strategy optimization, not curve fitting. You can either take 100, you can take 75, you can 25, whatever is your comfort, you take it. This is how you can put it. This is not the strategy I told you, right? I'm going to give you a framework on which you can build your strategies. Ways to improve the strategy: sell at 9:20, sell at 9:30, sell at 11:30. If you have a technical indicator which tells you that the market is oversold and the market should bounce back, create that strategy at that point of time. If RSI is below 30, start looking at the option premium. Once the RSI goes below 30, mark the level of 100 option and put a 10% stop loss. Percentage entry criteria, just not 10%, you can put 25%, you can put 20%. Don't go 5%, otherwise it is as good as selling the straddles or strangles, right? You can trade at the support and the resistance level if you're a discretionary trader. You want to trail the stop loss. I have not talked about the trailing of the stop loss, but you can trail the stop loss once you are in profit. So this is the the output of the strategy. Ashok, over to you.
Thank you very much, my friend. Sachin, are you there? Go ahead. Sachin, we can't hear you, my friend. Sachin? Okay, Sachin is gone. All right, no problem. So the friends, here is the desktop trading application Binge, an exclusive product by Espresso, the Sharekhan company. If you guys have any exposure to the Trade Tiger, it is more or less similar, much more agile and beautiful application. So the product team was not around, so we are just trying
Hello,
to
Ashok. I'm
explain.
audible?
Okay, sounds good. Can we move on to the next slide,
Hello.
Vishal? Yes, Sachin,
Yeah,
go
sure.
ahead. Yep.
I'm audible?
Yes, go
Yeah.
ahead.
Yeah. Sorry for the glitches. So, hello traders. This is Sachin Zawade from Espresso product team. Espresso is basically discount broking company working under Sharekhan group of companies. We offer pay when you profit model, where intraday it is designed for especially for the intraday traders. For more details, check our website myespresso.com. So here we are going to talk about Binge. Binge is basically a Windows-based desktop application, specially designed for the traders. Best in class experience for the chartists, for overall all kind of traders, real-time data feeds, multiple market scans, and many more. To check our demo watch list, you can visit our YouTube channel, which is Espresso Invest. So as we shall talk about a lot of things, what I have learned is about follow discipline, and that's what we always support, because market is not going anywhere. What you have to do, follow discipline, follow a tight risk management, and always keep in mind work with the capital, not for the profits. So that's what we always support. Here we have a variety of tools, and yes, we are working on it on the day by day. We offer a option chain which is very simple but yet powerful. Every data point in design in a such a way definitely going to help you to complete your analysis and make your trading day by day stronger. Then we focus new ways to trade. So simply what we have did here on the buyer price and offer price, we give a simple buy sell. Then in a right click, we have again given a buy sell. Then we also provide a bulk order where you can take advantage to place multiple orders. And yes, always we focus on the innovation. Then the tools which are going to help you out, one is a dynamic alert. Yeah, here you can run your queries. So approx around 18,000 of queries we can run, and then it is a real time basis. Then we provide a option calculator which is based on Black-Scholes model. Then we give a span calculator for your margin calculation. Next slide, please.
Yeah.
So here, what we are coming up with in future days, we are working on strategy order where you can complete your analysis, and you can place your all the trades with your strategy. So you can take advantage of your margins. Then yes, we are working on an option profile. It is a very unique concept what I come across in recent days, but definitely it will give you a surprise for the bench. Then yes, we are working on advanced trade points. Why I'm saying that, because traders are changing with every day is a new learning for us. And yes, we are working on the same, where you can where we can reduce your time and give you more accuracy, and will make you definitely a disciplined trader where you can win your battle. Thank you, Ashok. Over to you.
Ashok?
Thank you very much. So, ladies and gentlemen, here is a quick update about StrattleZone, the Amazon of strategies. So, this is an organization predominantly focusing on building 100% fully automated algo strategies for traders and investors. It's a complete end-to-end account management system which has close to about 10 strategies which have already been automated, with almost 40 strategies under development under a roof of 12 professional algo traders. So the minimum ticket size in this play is about 25 lakhs. So everything is automatic, purely back tested for a minimum of 60 months to 120 months if it is a future based strategy. Zero manual intervention, pure cloud strategy as a service. All right. The dream of StrattleZone robots is to double the capital in about 3 to 4 years, and a target of 10x in less than 10 years, which is typically a 26% CAGR kind of a return. For more details, please do log into www.strattazon.in, and there is a contact page. Please go ahead and fill the details. The relationship manager will get back to you. Thank you. Here is the free quant Panini strategy for all. I have seen a lot of people, romancing this strategy last couple of months. I have got a lot of updates. People have made good amount of money in the last 2 months. Of course, it has its own challenges. It does have its own drawdowns, but overall the strategy is quite robust. To grab it, just log into tradersgurukul.com. On the right top corner, there is a type in the keyword Panini, P-A-N-I-N-I, and you will get the strategy for free. You just have to subscribe to it, and you will have that recording for a lifetime access. And to be from the potential perspective, this year the strategy has earned more than 62%. This quarter has been relatively dry, okay, but the last quarter it has done almost like 17%. So that's the update about it. Over to you,
Yeah, so
Vishal.
I'm open to all the questions and answers.
Sounds good. So please move on to the back slide, Vishal, and then we will take up questions one by one. So friends, please start shooting your Q&A. Let me take up one by one. Okay, so Ashish Jain is asking, which tool or website do you use for automating?
So we have built our own in-house platform using Java. Yeah.
Sounds good. So can the SSS strategy work on equity cash market? From
No, see,
Mohan.
ideally the idea is to make money through a theta decay and the directional pay. We have not back tested it on any equity strategies, but yeah, you can try it, but we have not done it. But it's a good concept, and you may want to take that concept and build on it.
Sounds good. Okay, Vishal, how will the stop loss gets triggered when market goes up and you have sold a put option by Anant?
So it's an interesting point, Anand. So usually there are two kinds of stop losses, and we have been always been trained about or know about one stop loss. If we have a position, say if I'm selling something at 100 rupees, I'm going to put a stop loss because I'm going short on the market. I need to cover my short position, say at 110. I'm going to put a stop loss at 110. And till that point of time, that order is not shoot out to the market. It is kept at the broker's level. So once the 110 tick comes in, that order becomes a market order or a stop loss limit order, depending how you have kind of put it out into the system, and it gets triggered. So you would have a loss. Now, assuming you want to short something, but not at the current price, what you could have done is, assuming I don't want to sell at 100 rupees, it is like virtually you're thinking in your mind that I've gone long at 100. I want to get out of my position at 90. But virtually you have not put any trades. You are just thinking in your mind. Okay. So what we do is we don't sell at 100. We put an order to sell at 90. So that's how the stop loss, and we have a brilliant espresso team to guide you through if you have any questions on how to put those kind of stop losses.
Sounds good. Have you tried these straddles for stocks or at least range bound stocks like ITC? Does it work like Nifty by Vihan Mizarbak?
Sorry. So my philosophy, I told you, right? When I always take up a strategy, I think about the scalability. Do I want to here for thrill, or if I want to be here for a business? And the business is all about scalability. The stock options, yes, it would work on the stock options as well. But for us, we have not backtested it because our fundamental philosophy is that we want to build our strategies on a scalable model. And Nifty and Bank Nifty are the most scalable options in the entire universe right now. They are the most liquid options, right?
Sounds good. So Jaswinder is asking, what is the rationale behind selecting 100 rupees option strike and entry at 90% of that strike?
That's what I said. It is just somewhere we have to decide. Our risk profile allowed us to take 100 rupees. And if I go back to that slide that I showed you, you can take anything. 75, 50, 125, 150. It's just a round number, right? So there is no rationale. It's just our comfort zone of the risk to reward ratio was comfortable at 100 rupees. So, but if you're not comfortable and if you're a conservative trader, you can take 50. If you're an aggressive trader, you can take 150. Yeah.
Sounds good. Muninder is asking, can you explain the 10% rule with another example, please?
Sure, Maninder. So Maninder, just assume, okay, I'm going to, maybe confuse you even more, but I'll try my level best not to confuse you. Assuming you buy a stock at 100 rupees, you buy, okay? when would you make a loss? If you buy something at 100 rupees and it starts going down at 90 rupees, you're going to make a loss. And usually you will put a stop loss at 90 and say, you know what, if the prices goes even further, what if it becomes a yes bank? Okay, you're going to kind of get out of that stock at 90 rupees. That's a 10% below your purchase price. In our scenario, we are not purchasing anything, right? We were talking about selling options. So we said, okay, let's not sell at 100 rupees. But if the market shows a trend, okay, and if the market is going down, my call option will also go down. So I will not sell at 100 rupees. I will sell 10% below. So you are delaying your entry price, or you are delaying your entry price not at 100 rupees but at 90 rupees. You are saying, okay, you know what, I will let the market tell me that the market is going down, then only I will sell, which is 10% below the current market price. So I've tried my explaining way better, or maybe you can reach out. I'm going to share my Twitter handle and the mobile number. You can always reach out to me if you have any further queries.
Good one. So can this triple S strategy work for Nifty and Bank Nifty?
They are meant for Nifty and Bank Nifty both.
Superb. Now, with the new leverage model in place, how does it impact the returns?
Obviously, anything that is going to take out the leverage from your system, it is going to get impacted. Now you have to see that, do you want all the Virendra Sehwags or the Sachin Tendulkars in your team? No. You also want someone like Rahul Dravid or Mohammad Kaif in between to come and make some run for you when your openers are out. So you may have a risk strategies with the new margin coming in, and depends from the person to person. Okay. And the most important, sorry, I'm going to kind of answer that upfront. It will not impact that much because currently the rules that has been coming out with the new margin, I'm not talking about the September one, I'm talking about the 50% collateral and 50% cash margin. That will not have an impact because it's an intraday strategy. So on an intraday option strategies, you can still have 92, there are some brokers who are giving 100% collateral exposure. So that will not reduce your kind of return. But if you wanted to talk about the September margin, the full margin, you buy deep out of the money hedge, which is almost 4% away, and you will be in a sweet spot.
Sounds good. Malt is asking, have you ever tried this strategy on currency derivatives?
Not tried, but yeah, that is in the pipeline. But currency options are not that something that I have tried working with, and we have not got much success, to be honest, with currency options. Because see, Nifty and Bank Nifty, and especially Bank Nifty, is more volatile, and that gives you an opportunity to make money. Whereas currency options may be far more liquid, but hardly moves, and they don't have the juicy premiums like Bank Nifty, because when the Bank Nifty volatility moves, the volatility VIX moves, or I would not say VIX moves, but volatility gives you an opportunity to make money, higher premiums, the return on investment goes up. But a short answer to your question is no, we have not tried it.
Sounds good. So here is one more interesting question by Ravi Ram. He says, on expiry day, whether 100 rupee premium will be at by any chance at the money? Yes, if it is at the money, it's at the money straddle, right? Fair enough. No?
Yep. And that's what I said. You can, like, people will tell me that it's a strangle because you're selling 100 rupees and may not be at the money. But on a Thursday, it becomes a straddle. Most of the time it becomes straddle. So that's where it became like a smart straddle strategy, but you can call it as a smart triangle. So on Thursday, it is usually straddles, and on the other days, it is triangles.
So who is smart? Vishal is smart or the strategy is smart?
Strategy is always smart. That's what I kind of keep on telling my friends as well. When you are a discretionary trader, the edge is the trader. That's Vishal Mehta if I'm a discretionary trader. But if I'm a systematic trader with the rule-based approach, then my strategy is smart, my execution is smart, my backup of my execution is smart.
Good one. Very good one. This is what I always tell people. So many traders who visit us in our traders cafe, they keep asking, sir, I know this one great trader who uses 20 EMA and he makes a fortune. I think 20 EMA works. I always tell them, see, my friend, if somebody is making a fortune with 20 EMA, the credit goes to that person. That person, definitely not 20 EMA. There are 900 other guys who will lose money using 20 EMA.
That is so true.
Sir, how is it possible? Naturally, if Virat Kohli hits a century, the credit goes to Virat Kohli and not his bat. And then he says, "Oh yes, sir, now I understand." Anyway, so Karthik Gautam is asking, why don't we put a combined stop loss rather than individual stop loss?
So because we are turning this model into a trend model, we are not going for a delta neutral model. We start out as a delta thinking like a delta neutral model, but we actually make money on a direction, because once the direction is picked up, we are only be selling one side of the leg. We are not going to sell the other side of the leg. If I'm going to put a combined premium stop loss, if the market moves up or moves down in a big way, my both call and the put, because of the combined premium stop loss, would get triggered. But in this scenario, remember, if you can combine with this your straddle, it becomes a lethal strategy, because 920 is your combined stop. Say, assuming you put a strategy which is a combined stop loss strategy, and you combine this with a trend following strategy. This is like a momentum strategy. Why? Because if the market goes up, your only put will get triggered, your call will not get triggered, because you have put for the call option 10% below, which never gets triggered, right? So it turns into a trend following strategy. So when you combine, as I told you, you want like Virendra Sehwag, Sachin Tendulkar, good, but you also want Mohammad Kaif, and I'm coming from that clan way back. And Rahul
I
Dravid.
also get it because I don't remember any of the recent players.
Yeah.
Good one. Okay, we are from the era of Sachin Tendulkar, you know.
Yes, we are proud of that.
Yes. So the next question is, here is one very generic question by Anil Kubnani, but I personally feel this will help most of the people. Please do guide which is best option setup, whether it is best OTM, ATM, or in the money option.
The answer is, what is your fundamental philosophy about the market? If I'm going to give a hammer to a gardener, do you think he'll be a great gardener? The answer is no. And similarly, if I'm going to give a great plowing machine to a carpenter, he cannot be a good carpenter. So even if I say, okay, 920 is the best strategy, but your philosophy, because a lot of people think that option selling is dangerous because it is unlimited risk. Somewhere in your mind that is going to play out, and that will play with your psychology when you're losing money. I wish I would have an answer to that, but I think so. If you speak to any trader, he will answer the same thing. The answer is, we don't know which is the best strategy, straddle, OTM, ATM. Because I went to one of the conference recently, and there was a trader who sold option premium worth of 600 bucks. And I was like, dude, I would never do that. He made a killing. He made a big killing. If I was an outsider, I would think that he made so much of money, I should sell options, which is like 400, 500 rupees. But that's not me. I'm comfortable with 100 rupees. Maybe someone or you would be comfortable with 50 rupees. Your risk appetite, your return.
Good point. Sounds good. Next question. Mr. Punya Rao says, can you please give an example of both sides getting triggered?
So most of the time, both the times gets triggered, and as of now, we are on the PPD. I'm not able to sell you, but about 50 to 60 times, or maybe more than 60 times, both will get triggered. Okay, at least I'm talking about the entry. And if there was entry is triggered, then you will have a stop loss. But it works beautifully that 30% of the time. Remember, I told you in my earlier slide, the market trends 30% of the time, and 70% of the time it remains range bound. That 30% of the time, for that, this is the strategy, because when the market is trending, I'm just going to hit only one side of the leg, not the second side of the leg. So, but yeah, answer to your question, there are most of the time you will hit both the legs and both of the stop loss are one of the stop loss will get triggered for you.
Good one. Here is one very generic question once again, but I think everyone should know. Can you please explain the max drawdown concept once again by Vinay?
Sure. Let me just, can I try use a paint here? So,
Yeah, go ahead.
Ashok, can you just confirm that you are able to see the paint right now, MS
Yes,
Paint?
yes, yes,
Okay.
yes. Go ahead.
Say, assuming, guys, I'm using a mouse of a laptop, so correct me, like, just be with me, okay? So this is your original equity curve. This is where you started your 100 rupees, just for an example, okay? My 100 will not look like 100, but yeah. You made some money, it went to 110, okay? And then you lost some money, it came to 105. Oops. Trying my level best, okay? And then from there, you made even more money, it went to 120. And then all of a sudden, you had a loss-making trade which took the prices to 100, your profit to 103. And then there was another big rally or one big trade which took you to 150. Now this was the new equity high. When I say new equity high means the maximum profit that you have made was 150. Okay. If you take the difference between the two peaks, this is the peak and this is the peak. In this scenario, say assuming this was at say 110. Okay, this peak and this peak 120, this was the 5 rupee loss. This was almost 17 rupees loss. So as per me, between the two equity high, whatever the loss that I've made is my drawdown. So in this scenario, I've lost 5 rupees in the first time. And in this, I have lost 17 rupees. So what is maximum between the losses, 5 rupees or 17? The answer is 17. And that's my maximum drawdown.
Sounds good. All right. If you sold an option for 95, how did 390 rupees premium occur? Can you please elaborate that concept once again?
Okay, once again, then it is okay. Otherwise, I thought you would be thinking, okay, why it is there. And I've actually explained it very well when we talked about
This
it.
is Mr. TVSR Mohan. So it's good
Yeah.
to know because it is a unique scenario, no? It's good to
It
understand.
is a unique scenario when the March crash happened. Forget about the Bank Nifty future option premium became like a wild beast. So one option was trading at say 80 rupees and the next option was trading at 400 rupees because there was nothing in between. Okay. Because there was a circuit and nobody knew what was the pricing happening at that point of time. The immediate option which was above 100 rupees was 390 rupees, which actually turned into a zero. So yeah, that was a unique situation and that's why I elaborated also during the presentation.
Brilliant. Okay, very important question. I think you missed this aspect in your presentation. Kumaresan has reminded us what is the margin requirement of this strategy?
So you have to be smart enough to play this strategy, okay? One is either you can have certain automation tool. So ideally you would require say an option straddle right now costs around 1.6 lakh. Okay, if my last calculation was correct, 1.6 lakh is my if I'm selling straddles and strangles. But you need not put the orders. If you have some alert mechanism, if you have a sudden alert mechanism where when it gets triggered you get an alert, you short them. So I think so your call option or a put option now in the current scenario cost you around 1.3 lakh or 1.4 lakh.
Okay, but irrespective of whatever happens, Okay, you are saying that both the orders you will not punch immediately. You will punch it at a later point of time. That's what you're saying, right?
No, even if you put it out, uh, because you are going to put orders independently, you will not get a margin benefit. You have to hold the orders in your system, or maybe in an Excel or something like that, an automation tool. When the prices gets below 90, you get an alert and you sell at 90 or 91, whatever positive slippage also you may get. That will attract say around 1.4 lakh rupees as a margin. Now imagine the second order on the put side also gets triggered because
Correct.
you have
That's a
already a
typical
sold
straddle
call
now.
option. Yeah, so
Correct.
now it has become a straddle or a strangle because you have
Correct.
already sold the option premium. You have received that premium. Your margin will move not like a 3.2 or 3 point, it goes to 1.6 lakh.
Okay, then you need to add up the drawdown also, no? So technically 2 lakh rupees per strategy
Is
per
per
lot.
strategy. Yes, yes.
Okay. Sounds good. Okay, Snehasis Ghosh Hazra is asking what is the success rate of this strategy. So it's not about
68%.
success rate. How did you decide that, Vishal? You saw the number of months of success. Is that the way?
Yeah, number of
Or win
days. Number
days?
of days.
Number of
62% of the
days of
days has been profitable.
perfect. Perfect. Yeah. So let me look out for the next question. Did you ever get into a situation where stop loss order impacted by freak trades by Balaji Rajkumar?
Luckily, we stopped our algo the day that 16,450 trade came in. I'll be brutally honest that we were shit scared because we had a large positions, but luckily we do not trade like this strategy we traded, but the other strategies where our maximum exposure is there, we trade only on Wednesday, Thursday, and it happened on I think so on a Friday or a Monday, and we stopped our algos and we were using stop loss market orders. We turned the algo off for a month period and we turned everything to stop loss limit. So fortunate for us, but I told you right on my second or third slide, there is a bullet waiting for us. If you are doing an option selling, you have to live with that mentality that there is a bullet for you. That freak trade is waiting for you to happen some way or the other. So try to keep your exposure accordingly in the check. But yeah, freak trades are real. Although they have gone down recently a lot, but still there are a lot of freak trades happening. Also about say a few days back, there was a freak trade happened. But yeah, unfortunately, I've seen a lot of people losing money, but we were not on that side of the equation.
Sounds good. Now, here is one very interesting question. Are the backtesting results considered the premium of 100 points? Is it common for both Nifty and Bank Nifty since their numbers are different?
No, so it is, we have done it only for Bank Nifty and our predominant exposure is on the Bank Nifty. You can also, just try to work with the Nifty as well. So as of now, we predominantly trade the Bank Nifty one.
Sounds good. So I am hoping that these strategies can be traded every day, not just on expiry days. Is the question by Siddharth.
Yeah. But I always being a very smart bum, I always have the low exposure on the other days and double it up on the Wednesdays and Thursdays.
Sounds good. Why does everyone use Bank Nifty mostly and not Nifty? So once again confirming if the strategy does work for Nifty as well, not just the SM but also for the 920 straddle. Does it work for Nifty also? Okay, in simple words, Bihan is asking, can I apply this for Nifty also? Answer is yes. Correct, Vishal?
Yes and no. Okay, I'll tell you why. Okay, it will work in the Nifty as well, but the point here you have to always think what kind of instrument and what kind of strategy. It's like hero and heroine, right? For a movie, if you're a director, you really wanted to, you can't have an heroine which is like 6'5" and a hero which is 5'4". Similarly, when we are trying to build a trend following model on an option, because Bank Nifty consists of 13-14 stocks of banks, any announcement on the banking sector or an RBI coming and making an announcement will trend in a big way. And because our model is more of a trend, not a delta neutral, remember that. Because once the market goes up, only put side gets triggered, not the call side. And we want the instrument which are more trendy in nature. And Bank Nifty is far more trendy. Barring last June to September, Bank Nifty has always been trending. Okay. So that's where we prefer to use trending model. If I was using a standard straddles and strangles, I would use Nifty, because in Nifty, even if Reliance has a Aramco deal going down, there was Bharti Airtel who said that, you know, I'm going to increase the price. Two different sectors coming out with two different announcements, and the index management happens. So my straddles and strangles tend to be more stable. Whereas Bank Nifty announcement on banking sector can just crush at one direction, and I'm going to benefit from it.
Sounds good. And here is one question by Mr. Swanand Ghanekar. So finally, what is the capital and what is the average annual return that I can expect out of this strategy?
No, I'm not going to give you, I have never given you a strategy. I've given a framework for you to build the strategy, right? So you have your numbers, you have your return calculation, you can do the calculation. I'm not selling any strategies.
What will you do when you have high volatility days and both sides stop loss gets hit? We take stop loss. What else?
Simple. As a systematic trader, market is nothing but a systematic transfer of money from an indisciplined trader to a disciplined trader. Simple.
Good one. Are there chances of both stop loss triggering? Then how we make money if both triggered? So Mr. Digital Nandi, answer is same. Follow the
No,
process,
so
stick to the rule book.
answer is this: laws of large number. Because you will, if there have been months where both the stop loss gets triggered, you will keep on losing, you will keep on bleeding. But has the strategy in the long run as a positive expectancy? If the answer is yes, you will end up making money. Because a lot of us think that, you know, the minute I start trading, I should make money. That's how we have been groomed, right? And as I told you that why 90% of the traders, so one of my good friend who runs a broking company tells me that 90% of my trader lose 90% of their capital in the first 90 days. And
Good
that's
one.
a broker who is telling us, right?
90,
and why
90,
90%? Yeah, 90% of the trader loses 90% of their capital on the first 90 days. Why? Because from the childhood, we have been trained not to make money in the market. What do I mean by that? Is basically, if there is a child, your child gets 9 marks out of 10 marks, the first question that we ask them is not to encourage them that brilliant, you got 9 marks. We say, where did you lose 1 mark? And we have been trained to be right all the time to be successful. And in the market, the best of the best traders are right only 50 to 60% of the time.
Good one.
Yeah.
Very nice. Mr. Hiren Patel is asking, can this strategy ever work with super trend as stop loss?
Yeah, trailing stop loss, remember? I have done a brilliant strategy on YouTube available for free, which is profitable. You can use super trend in that as well. Yeah.
So Mayur is asking, do we need to watch out for indicators? Mayur, this is all about quants. There's only predefined process in place. You just have to follow the process. You don't have to look for any additional indicators as such. This is a brilliant question. I think you need to address it. Pankaj Malhotra says, when to know that this time strategy is not working needs to be tweaked. Maybe if it hits your max drawdown, or you have anything else.
Usually as a system trader, we have a philosophy that your max drawdown in the back testing is just a number. Ideally, your biggest drawdown will happen in the future, because when you are backtesting a strategy, you will change the parameter to come to your comfort level, and the drawdown will be in your comfort zone. but that does not mean that you have tweaked certain data to get into the optimization phase. When your bigger drawdown will come in the future, and there is only one way of deciding your comfort zone or just going out of your comfort zone is basically take the 2 times of your historical drawdown, and once that hits, you get out of the strategy. That does not mean that strategy is failed. That means that you should be getting out of that strategy because that's above your max pain area. There would be a chance, say assuming historically a strategy which would have given a drawdown of max drawdown of 10%, you stopped at 20% thinking the strategy is broken, it goes to 30% and recovers everything and just turns into a big profitable strategy.
Okay, there's little advanced question. Mr. Sanket Roy says, how option Greeks affects this strategy?
Sorry, how?
Option Greeks affects this strategy.
So we are trying to make a delta neutral strategy because when your premiums are neutral, greater than 100, that's a delta neutral strategy, right? But although we are not actually selling both 100 and 100, so we don't have a delta. So it kind of follows a normal Greek profile of an option seller. The time decay, if it is Thursday, will benefit you. If the delta, if it is in your favor, if you have sold a put and the market is going up, it will favor you. If the market is become volatile, it will go against you because you have sold a seller of an option. So this is how your like any option selling, Greeks will get affected. This strategy will get affected.
Good one. Mr. Ridhiman is asking, can we apply this strategy to crude, gold, or other commodities?
Ridhiman, I would love you to backtest that strategy and come out with an answer and give me or tag me on Twitter, and I would love to have a conversation with you. Unfortunately, we have not backtested it, but yes.
I have a question now myself. Does this all commodities have good options and corresponding liquidity by any chance?
I don't know. That's why you should ask Ridhiman.
Okay, sounds good. Okay, and here is one important question. I'm sorry, that question was not from Ridhiman, somebody else. Ridhiman gave a beautiful question to me. Please tell something about position sizing and resizing if it's required. How to manage positions?
So we are a conservative trader, Ridhiman. So we do is take the margin, we take the historical drawdown and multiply it by 2 times. And that's our one set of running this strategy. Say assuming this strategy requires 2 lakh of say 1.5 lakh as a margin and a 25,000 was a historical drawdown. So I will not trade based on 1.5 lakh. I will actually trade this with 2 lakh because I know for the fact that I'm going to have a drawdown and I need to be comfortable because I can just bump up my return by just trading by 1.5 lakh. But whenever there is a drawdown, where am I going to put my money from? So at least if I would have put enough money for the cushion, I will be surviving in the long run. Now, when do I increase my position sizing? Now that's a very tricky one, Ridhiman, because I'll tell you, if I'm going to go by a standard rule of 2 lakh rupees, and every time that 2 lakh rupees is profit is reached, I'm going to increase by 1 lot, which has its advantage and disadvantage. Let's talk about disadvantage first. Disadvantage is because you have to trading only 1 lot. You're trading 1 lot. You will take a lot of time to reach 2 lakh rupees to increase to the first next level. But if assuming you reach say to a 10 lot doing this process, your 2 lakh rupee increment, because now you are not trading 1 lot, you are trading 10 lots. The 2 lakh multiplier becomes 4 or 5 lakh. In terms of in the one trade only you will make 5 lakh rupees, say 4 lakh rupees. The next trade you will be trading at 12 lakh rupees, and assuming you made a profit on that of say 6 lakh rupees, then you will be trading at say 17-18 lots, and then you hit a loss and a drawdown. It will hit you hard. So there is something called as a fixed ratio, and I want you to kind of go to the net and figure out there is something called as a fixed ratio money management by Ryan Jones. He comes out with a beautiful example of when to increase and when to decrease your position size if you are trading leverage instruments.
Good one. Cool. And there are people asking whether this strategy work on expiry date too. Friends, this is a strategy which is applicable for every day. It is a pure intraday strategy for every day. So that is the answer. Okay, cool. So I think we have answered most of the questions. It is time to close up. So friends,
So
how
guys,
was the
this is
session
my
overall?
Twitter handle. So please do tag me if you like the session and if you make money. And obviously, if you lose money, please also, I'm open to criticism till it is in the boundary of understanding of the topics and the subject.
They will praise you if you refund their money.
Yeah, see, everything is refund, right?
All right, sounds good. So, so friends, I hope every one of you enjoyed this session today. And my friend Vishal, that was a good session, quite an
Thanks a lot,
interesting
Ashok,
session.
and thank you everyone. You're still awake till 10 o'clock, so really appreciate everyone. Thank you.
So I'm sure this session will open ideas for people to kick off with straddle and strangle strategies, and they also move towards quants, which we have been done in the past few years. Well, on behalf of our media partner Money Control Pro, our title sponsor Espresso, the Sharekhan company, and my extended traders Gurukul family members, we sincerely convey our regards for sharing your experience and knowledge to our Intrazon 2.0 family members. Thank you very much once again, Vishal Mehta.
Thank you. Thank you, everyone.
So friends, that's the story for today. With this, we successfully completed 4 sessions of the 12 session series. That is typically 33.33%. So 1/3 of the seminar is more or less done. I hope it has been a very interesting journey for all of you. I look forward to see you all tomorrow at 8 p.m. sharp with yet another interesting speaker. Until then, signing off, Ashok Devanampriya from Traders Gurukul. Good night.